Hey, 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 some good news on the stock market valuation front. This is good. This is from Goldman Sachs, and we're going to get into this here in just a second. Some positivity, and I like that. I like to be positive because there's a lot of doomsday out there, and doomsday sells, I get it. If it believes, it leads. But I think there's an alternative to say, oh, we're all going to die by a stock market crash. Anyway, so we're going to start with looking at John Bogle's book, Common Sense on Mutual Funds. They had written or published in 1999, which I have a signed copy of because I worked at Vanguard in 1999. And Bogle was doing his tour among the Vanguard places. We were working in, I can't remember if we were at Camelback then or if we were at North Scottsdale. I think we might have moved from Camelback to North Scottsdale. Yeah, I think we did. And he just had a little table, and everyone who worked there, he gave a book and he signed it. And then he nominated me to be CEO because I came and I said, hey, look at my pearly yellows, Mr. Bogle. He goes, Scanlon, I like you. You should be the CEO after me. And then Jack Brennan cut me off the knees. Oh, Jack Brennan. Anyway, so we're going to go to page 38 of this book right here. And just Bogle's a legend. And Bogle says, oh, by the way, do you have a signed copy? No, you don't. Because I'm too cool for school. And you're a fool who likes to drool in the pool. All right. Now that's freaking professionalism right there, baby. Total return is simply the sum of three factors, says John Bogle, the GOAT. Three factors. For example, an initial dividend yield of, say, 3%, plus a forecasted earnings growth of, say, 7%, will give us a 10% rate of return over the next, will give us a 10% rate of return. That's what he's saying. But Josh, you said there's three factors. I did. Dividend yield plus earnings growth. A change in the price to earnings ratio, we'll say from 15 to 18, will add another 2% to our total return. So our expected rate of return based on these three things, earnings growth plus dividend yield plus change in price to earnings ratio. In this case, an expansion of the price to earnings ratio would give us a 12% rate of return. All right, so he says right here, earnings growth 7 plus 3 plus 2 equals 12. That makes sense. Now, the problem is right now is our dividend yield is about 1, and a lot of people are saying our PE won't expand, it'll actually contract, which will just, for simplicity, say, and then our earnings growth will be 6. This is what I would actually say. 6 plus 1 minus 2. So we got 6 plus 1. This is what Vanguard says too, by the way, equals 5. So our PE will contract from 18 to 15 for simplicity. It's not 18, trust me. Our dividend yield is not 3%, and our earnings growth will say 6%. So we'd say instead of getting a 12% rate of return a la Bogle in 1999, we'd expect a 5% rate of return. I completely agree with that, 100%. And that's what Goldman Sachs talks about here. Very interesting. So Goldman Sachs gives us a little bit more positivity than what I'm showing. So we go down here, and this is from 12 November 2025. Sachs full of gold. All right. We expect global equities to deliver strong long-term returns despite elevated valuations. So despite elevated valuations, i.e., we're not at right here, the price to earnings contraction would be more appropriate simply because the valuations on stocks are so high right now. That's hard to see that they're going to expand. And if they don't expand, they're either going to stay flat or they're going to drop. And the way they drop, a lot of people think, is by a massive sell-off. People are going to sell. I'm not going to pay $30 a share for a stock for Microsoft, for instance. I'll pay $20 a share for a Microsoft stock. And then that would be a contraction of, what is that, friggin' 33%. So you see a 33% decline in PE ratio. A massive contraction. All right. What would that do for the overall market? I don't know. But that certainly wouldn't be, it would not be positive, that's for sure. Because people say the valuations are too high. I'm going to sell. All right. And Goldman Sachs says, no, we get it. We 100% get it. We say the valuations are elevated for sure. Our forecast is 7.7% in US dollars, says close to historical median. supported by structures such as growth of earnings and profitability and shareholder distributions. Interesting. We apply a building block methodology where total return equals earnings growth plus valuation change plus dividend yield. Where have I heard that before? Earnings growth remains the primary driver of performance. We expect global earnings growth, including buybacks, to compound at roughly 6%. Dividends provide the rest of the return, while we expect valuations to ease modestly from current highs. Interesting. So they're saying right here, dividends, earnings growth be 6, basically dividends, right, in the United States about 1 to 1.5, we'll just say. All right, and they're saying, we'll just maybe 1%. Well, that'd be in the United States. Well, they're actually saying really nothing. So really no change, in the PE ratio, none. Right there. So earnings growth 6%, dividend yield, and this is an international 7.5. Really no change in the PE ratio. That's global. So what do they say about the United States? United States, 6.5%, driven primarily by earnings growth and modest dividends, while buybacks compensate for the valuation drag. Buybacks compensate for the valuation drag. So what do buybacks do? All right, let's go back to the thing here. All right, so here you got a stock that has a price of 1, all right, and earning, so they got 1 share outstanding, all right? So you got a price of 1 and earnings of 1. So you're basically paying, your PE ratio is 1. You're basically saying for every dollar it costs me, for every dollar of earnings, I pay $1. Pretty makes sense, right? $1 of earnings, dollar for price. You're paying $1 for every dollar of earnings. That's a PE ratio of 1. All right. So now let's see what happens though. If we still got 1 earning, $1 of earnings, and now people are bidding up the price to 2. What happens there? What happens to our PE ratio? Well, our price has now doubled because we went from $1 for every dollar of earnings to $2 of price for every dollar of earnings. So our PE ratio is now 2. We have a 100% increase in PE ratio. So all things being equal, if you bought that at 1, now you have doubled your money if someone else is going to buy from you at 2. All right. Now, what happens if we reduce the number of shares outstanding? Instead of having 1 share here, all right, 1 share, now we only have a half a share, just for simplicity. All right, so now we got 1/2 of a share. Earnings haven't changed, but the earnings per share has, because we now have 1/2 of a share and our earnings haven't changed. Essentially, each share is worth $2 of value. And so now our price earnings ratio is back to 1. Does that make sense? Because when you eliminate the number of shares outstanding, as long as the earnings stay put, the price per share inherently becomes lower. The PE ratio becomes lower because we don't have as many shares outstanding, and the price inherently stays the same. The earnings stay the same, but the number of shares outstanding. We reduce the supply. All right, and so in that case, that's what Goldman Sachs is saying is going to happen. Is potentially going to happen. They don't know. They're saying it potentially could happen. So we have an elevated share price in terms of price to earnings ratio. But one of the ways we alleviate that in terms of people saying there's going to be a massive contraction of PE ratios is we reduce the number of shares outstanding. And that will reduce the massive contraction. I mean, that will make a contraction for sure, but in terms of PE ratio, but it's not because of the price going down, it's because of the number of shares outstanding. Anyway, I find that very interesting. And as the lower the PE ratio gets, the less valued people say it is, the less potential for more contraction there is. I think it's very interesting. I actually agree with that 100%. Buybacks are a way to basically reduce the PE ratio unequivocally, the price to earnings, because earnings per share, always remember that, earnings per share. So buybacks are a way to do that and to stop some of the negative Nellies saying, oh, the prices are so high, the elevation's too high. Now, it used to go back to dividend yield. So it used to be, hey, instead of buybacks, we'll give the dividends. Now they're saying, but dividend yields are taxed today. All right, buybacks aren't taxed until you sell it. Tax perspective, man, so it makes sense to buy back shares as opposed to give it a dividend. And I'm not sure what I wonder if they, I'm not going to look into it. I just wonder, I bet if you look historically, the average dividend yield was say 4%. I bet if you look historically, the stock buybacks plus dividend yields, I bet it averages about 4%. I bet in terms of overall performance of the markets. I haven't looked. You can prove me wrong. It's fine. But essentially, what it seems to me, and I don't follow this that much because it bores me to death. Just buy the damn index and be done with it. But it seems to me, at the end of the day, companies have cash flow. They can use it for a couple of things. They can increase research and development. They can give salary increases, blah, blah, blah. Give dividends, buy back shares, all these things. I got sneaky suspicion in the old days they used to give dividends, and now they're saying we're not going to give dividends anymore because it's taxed immediately at the source. We're going to actually give stock buybacks, which are taxed when you sell it, if that makes sense. So you don't have to pay a tax on that because you increased you've increased the valuation, absolutely, of your shares because you've reduced the PE ratio. So I have a sneaky suspicion that did say, nah, we're not, we're the same cash flow is going to buybacks and dividend yields, whereas before it's just dividend yield. So anyway, I know that probably doesn't make sense, but at the end of the day, just buy the damn index and be done with it. Now, should you buy foreign stuff? If you want, I can no qualm that. Goldman Sachs says foreign stuff should give you a better rate of return. They're saying the United States about 6.5%, Europe about 7.2%, Japan 8.2%. I don't know, man. Underpinned by EPS growth of 6% and policy-led improvements in payouts. I don't know what that means. Asia ex Japan 10.3. I don't know, dude. That seems emerging markets. I don't buy that for 2 seconds flat. Emerging markets by strong earnings per growth share in China, India, maybe. I'm just going to stick with the good old USA, baby. USA or bust. All right, God bless. We'll see you. Smash that like button.